You swipe your card. The payment goes through instantly. No delay. No friction. No visible cost. But here's the uncomfortable part. At that exact moment, you just spent money that didn't exist a few seconds earlier. Not your money. Not the bank's money either. New money. Created quietly. The moment you decided to buy something. Most people think banks are middlemen. They take deposits from savers and lend them to borrowers. That story feels logical, clean, safe. It's also incomplete, because in the modern financial system, banks don't just move money. They manufacture spending power out of nothing before you even earn it. And once you see how it works, it becomes hard to unsee. Let's start with something simple. You walk into a bank and take out a loan, say $10,000. What do you imagine happens? Most people picture the bank reaching into a pool of deposits, pulling out someone else's savings, and handing it to you, but that's not what happens. Instead, the bank opens your account and types in a number, plus 10,000. That's it. No bolto opens. No one else's balance decreases. Your loan becomes a deposit. Instantly, the money is created in that moment, and now you can spend it. This sounds abstract, so let's make it real. You take that $10,000 and buy a used car. The seller deposits the money into their bank account. Now the system shows two things at once. You owe $10,000 to the bank. The seller has $10,000 in their account. Same money counted in two places. Debt on one side, deposits on the other. This is how most money in the economy comes into existence. Not printed by governments, not mined like gold, but created as debt. Here's where it gets more interesting. The bank didn't need your future income to exist before creating that $10,000. It created spending power first, and trusted that your future work will justify it later. Think about that. The system is pulling value from your future and injecting it into the present, before you've earned it, before the economy has produced it. That's why it feels so smooth when you spend, because the friction is delayed. Now scale this up. Millions of people taking loans, mortgages, credit cards, business financing, each one creating new deposits, each one expanding the total amount of money circulating in the economy. This is how economies grow quickly. More lending means more spending. More spending means more income for someone else, which then justifies more lending. A loop, self-reinforcing, until it isn't. Because there's a catch. The money is easy to create, but the repayment isn't. When you borrow $10,000, you don't just owe $10,000 back. You owe interest, let's say 7%. Now you owe $10,700. But the system only created $10,000. So where does the extra $700 come from? It has to come from somewhere else in the economy. Someone else's income, someone else's borrowing, or new loans, which means the system quietly depends on continuous expansion. New debt to pay for old debt. This is where things start to feel a little unstable, because if lending slows down, the creation of new money slows down too. But the obligations remain. People still owe principal, plus interest. Suddenly, there's less money moving around, but the same amount of debt demanding repayment. That's when things tighten. Spending drops. Businesses feel it. Jobs get cut. Not because money disappeared, but because the creation of new money slowed. And here's the strange part. From the outside, it doesn't look like a money creation system. It looks like a credit system. Offers, limits, scores, approved, denied. But underneath all of that, it's a mechanism that decides who gets access to newly created purchasing power, and when, before the economy has actually earned it. Now think about timing. When do banks tend to lend the most? When the economy looks strong, when asset prices are rising, when confidence is high. That's when money creation accelerates. More mortgages, higher home prices, more borrowing against those higher prices, which pushes prices even higher. Feels like growth, but part of that growth is just expanding balance sheets. Then something shifts. Maybe interest rates rise. Maybe defaults tick up. Maybe confidence drops. Banks pull back. Lending tightens. And suddenly, the creation of new money slows down. But prices don't instantly adjust. Debts don't shrink. The system starts to reverse. This is why economic cycles can feel so abrupt. On the way up, money is being created quietly, distributed through loans, hidden behind everyday transactions. On the way down, that process stalls, and what's left is the weight of accumulated debt, without the same flow of new money to support it. There's an irony here. The system gives you spending power before you earn it, but demands repayment after conditions change. You take the risk in real time. The system adjusts later. And yet, this mechanism isn't broken. It's intentional, because creating money through lending allows economies to grow faster than they otherwise could. It pulls future demand into the present. It finances businesses. It builds homes. It fuels expansion. But it also means the economy is always leaning slightly forward, dependent on the next wave of borrowing. So the next time a transaction feels instant, effortless, almost invisible, it's worth asking a simple question. If so much of today's spending power is created before it's earned, then what happens when the future finally arrives and can't keep up?